So earlier in the year, we touched on the US Federal Reserve, the central bank of the world's largest economy, and the actions that they were taking there and the influence it was having on financial markets. Now, the Fed hiked interest rates in December last year, and that tightening of monetary policy and the constraint that it had on global liquidity was having a negative impact on appetite for risk, and particularly on returns in a lot of equity markets around the world. And I'd like to update us on that factor. What we've seen in the first half of this year is the Fed has not continued to hike interest rates. And the real question there, does that mean that the risk appetite will just return and that equity markets will continue to post strong gains because we've seen an end to that factor? And the real question, the answer there is no. And the reason why is because of the reason why the Fed has decided not to take that action. And they're really worried about global economic growth, both global economic growth and economic growth in the US. And that's why they decided not to continue to tighten monetary policy. And if economic growth is really weak, that says a lot about the global investment conditions at the moment. Without economic growth, it's difficult for corporates to be profitable. And without profitable businesses, that's difficult to see strong returns on equity markets. And that's the real take home here for clients, that you see a lot of news in the media about the Fed each month and whether they hike rates or not hike rates. But the real factor here is that global growth is weak. And without global growth being strong, it's difficult to see strong equity market returns. And as a result, we continue to advise clients to have lower return expectations. And the managers are managing in such a way to be prudent, to manage the risk and manage the risk that we're seeing in global equity markets at the moment, and protect capital for clients in these turbulent and uncertain times.